CVS Health, one of the leading companies in the healthcare industry, reported mediocre financial results in 2022. They saw a significant increase in revenue, which rose by 10.7%. However, their net income experienced a decline of 48% year over year, while the stock price decreased by approximately 28% during the same period. They will take a three-step approach to thoroughly evaluate the company and determine their fair value. Step 1. Margin of safety. In this step, we'll use CVS's key metrics and ratios to determine if we should be more or less cautious when determining a fair value. Here we'll delve into CVS's financial statements and assess critical metrics and ratios. In step 3, we will use a combination of valuation models such as discounted cash flow and discounted dividend to get an insight into the value of CVS's business. By using these methods, we determine whether the stock is currently over or undervalued in the current market on different metrics. In conclusion, by combining the findings from the 3 steps, we'll ultimately determine the fair value of CVS as an investment opportunity. To determine the final value of the stock, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company, and we'll be using a standard margin of safety of 25% that can never go below 0%. The margin of safety can either increase or decrease based on the ratios that we're going to look at in just a moment. And the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in our scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction from a margin of safety. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction. First metrics that we'll be looking at are the EBIT growth and the margin growth. The EBIT has gone up over the years, going from almost $8 billion in 2013 to over $15 billion in 2022. The average growth during this period has been sitting at almost 8%, which looking at our scale is no change in the margin of safety. Margin has gone down over the years, going from almost 6.3% in 2013 to almost 4.8% in 2022. The average margin decline during this period was 2.8%, which looking at our scale is a 5% increase in the margin of safety on this metric. The next metrics that we'll be using are the dividend growth and the payout ratio. Dividends have gone up over the years, going from 90 cents a share in 2013 to $2.42 a share in 2023. The average dividend growth during this period is 11%, which is a 10% deduction from a margin of safety. This with a payout ratio that is sitting at 76%, which looking at our scale on this metric is no change in the margin of safety. The final 2 metrics that we'll be using are the debt to EBITDA and return on invested capital. To get a debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debt. And for CVS, this is almost 3 years, in this case, a 280% debt to EBITDA ratio. This falls in the orange part of our scale, meaning no change in the margin of safety on this metric. The return on invested capital for CVS is sitting at 6.5%, which once again looking at our scale is no change in the margin of safety on this metric either. Let's go look at the valuation models next to determine the intrinsic value of the company. The first valuation model that we'll be using is the discounted cash flow model. I've imported free cash flow of CVS going from 2013 to 2022. The average growth in their free cash flow annually during this period has been sitting at almost 18%, and I'm projecting an expected future growth rate in their annual free cash flow of 4% for the next 10 years. With this percentage, we'll determine the future free cash flow for CVS and determine a terminal year of valuation using a perpetual growth rate of 3% and a discount rate of 8.5%. This gives us a sum of free cash flow of $247 billion, and to get our equity value, we have to add the cash and equivalents and subtract the debt, leaving us with an equity value of $202 billion, and dividing this by the amount of shares outstanding, we get a discounted cash flow price per share of $157.88, which is a 110% upside from the current price. The second model that we'll be using is the dividend discount model. I've imported the dividend payouts of CVS going from 4 years ago to the current year. The average growth rate in the dividends during this period was sitting at 5%, and I'm projecting their future dividend growth to be this exact same dividend growth it has been in the past 5 years, of 5%. I will once again be using a discount rate of 8.5% in this valuation, giving us a dividend discount model price per share of $72.60, which is a 3.26% downside from the current price. The third model that we'll be using is Graham's revised valuation formula. In this model, we take a look at the earnings per share that CVS is generating, the growth rate estimate projected by Wall Street, and the current yield of AAA corporate bonds in relation to the average yield of AAA corporate bonds, always sitting at 4.4. And we go by the theory of Benjamin Graham that the PE of a company with no growth should never exceed 7. And looking at all of these metrics, we get a fair value out of this model of $34.62, which is a 54% downside from the current price. Fourth model that we'll be using is the multiple valuation. In this model, we take a look at similar companies to CVS, look at their stock price and their earnings per share. This way, we can determine the average PE multiple in the industry, which in this case is sitting at 18.09. All the stuff to do to get a fair value out of this model then is to multiply by the earnings per share that CVS is generating, which is $3.01, leaving us with a fair value of $54.46, which is a 27.43% downside from the current price. And the last model that we'll be using is the mean reversion theory. In this model, we go by the theory that a company will always trade above or below its mean, and the metrics that we use to determine this are the dividend yield and the PE ratio. In this case, I've imported the dividend yield of the past 5 years, and on average it has been sitting at 2.64%, while the current yield is sitting at 1.67%, indicating that it's currently overvalued on this metric. Doing the same with the PE ratio, the average PE ratio of the past 5 years has been sitting at 17.72, while the current PE ratio is sitting at 13.48, indicating that it's undervalued on this metric. This leaves us with a fair value of $73.04, which is almost a 3% downside from the current price. If you want to get access to all of the models that I use in my videos and much more, you can check in the description for my Patreon link. Anyways, getting the self-promotion out of the way, let's go look at the final overview of a valuation next. Looking at our final overview, we've imported the discounted cash flow, discounted dividend, Graham's valuation, multiple valuation, and the mean reversion theory price per share, giving us an average of $78.52. Our margin of safety we've determined earlier, using a standard margin of safety of 25%, adding 5% for the margin growth and deducting it by 10% for the dividend growth, leaving us with a 20% margin of safety. Applying this margin of safety, we get a fair value of $62.82, and with the current price of $75.05, we get a downside of 16.3%, indicating that's currently a sell. If there's any other companies that you would like to see me cover on this channel, please let me know in the comments, and thanks for watching.